Hey guys, welcome back to another weekly market update and forecast video. I hope you guys are doing well, having a good week, staying safe, and taking it one step at a time. This week has been full of positivity for us, not in terms of loads, but in terms of other business-related things. First, we finally found and hired a team member to drive the flatbed. Second of all, we got news this past week that one of our trucks is going to be delivered by the end of the month, which is super exciting. And third, and most importantly, we finally got some business-altering news regarding the AB5 law, and I'm going to share that with you at the end of this video. Now, if you're new to my channel, welcome. I teach about the trucking industry with a heavy focus on the spot market as well as freight market analysis. So if this is a topic that interests you, feel free to subscribe down below. Anyway, guys, let's go ahead and look at some data, see what happened this past week in the market, what we can expect next week, and then I'm going to share those big AB5 news with you at the end of the video. Ready? Let's go. All right, as always, we're going to start with the outbound tender volumes versus rejections, right? So again, we have a blue line here, which shows us the volume. How much freight is there in the market? The white line shows us how much of that freight is getting rejected and ending up on the spot market. So for those of you who are new, the higher the tender rejections, the more volume ends up on the spot market, driving spot rates up. So we can see that volumes have gone up. Now they're on their way down, but this is normal after Memorial Day. Now, tender rejections, which is really nice, they're continuing to go up. And currently, we are at 3.15% in terms of tender rejections, which means that 3.15% of the loads end up on the spot market. And of course, the higher this number, the better. We have been trending in the twos, so 3.15 is something to be happy about. Again, I try to celebrate small wins. I completely understand that this is nowhere near where we should be, but still, at least it's better than it was before. If you're wondering why tender rejections went up, well, it's most likely because of volumes. So as volumes increase, especially if there is a very steep increase in volumes, if there's a steep increase in volumes, usually it drags the tender rejections with it. Why is that? Well, because carriers, when volumes increase, they have more things to choose from. So they feel more confident rejecting freight. So that is probably the explanation for this tender rejection increase. But now I want to go to the seasonal chart because I want to see how we compare to prior years. So I know that this chart is probably hard to see. That's why everything is going to be attached down below. But for now, what you should know is that this blue line, the one that is colored in, this is us in 2023, and we're looking at volumes. Now, the other lines, they're different years, prior years. And what we can see is that we're following the same pattern as prior years, as you can see here, but the increase in volume was quite a bit bigger after Memorial Day than the previous 5 years. Now, currently, we're trending in terms of volume somewhere around the yellow line, which is the 2018 levels. And if we look in general, we can see that before the 4th of July, we should experience another bump in volume. We can see it in 2018, we can see it in 2019, we can see it, well, 2020 was a crazy year, but 2021 and 2022, there was a bump. So we can expect volumes to continue to increase before the 4th of July. So at least we have something to look forward to. Now let's take a look at the same chart, but for tender rejections. So on this chart, this blue line, this is us right now, and all the other lines are previous years. Well, there's no denying it. We're kind of at the bottom and we're not really moving much relatively, right? So in 5 years, we're at the lowest tender rejection rate, which is not great. But something that we can expect from prior years is that usually in the beginning, end of June, beginning of July, there is a small bump in tender rejection rates. So here's hoping we see a small bump in tender rejection rates, and maybe as capacity continues decreasing in the market, hopefully consumer demand doesn't dwindle too much and volume stays relatively strong, and we'll see those tender rejections increasing. But currently, in the 5 years, look at this, we're kind of flat in terms of tender rejections. Okay, on to the NTIL, which is the National Truckload Index for line haul only. And this is data from dry van operations, right? This is collected from dry van operations, and it's basically the average spot market rate, not including fuel surcharge. And we can see that since the beginning of June, we have plateaued at $1.64 per mile. This is where we are currently. There was a small peak, but in general, we are plateauing right here. But let's take a look at what is happening with the contract to spot rate spread. As we can see, the contract to spot spread keeps decreasing. Last week it was 81 cents, now it's 76 cents, which means that contract rates on average now pay only 76 cents more than the spot market. Only. At least it's not 81 cents. But this is happening because contracts are getting renegotiated. One thing you have to remember is that contract, it does follow the spot market. It just follows it with a huge delay. So the crap storm that we have been experiencing for the past year almost is only now starting to hit the contract market. So we can expect this spread to continue decreasing. All right, now let's take a look at some diesel prices. And good news here, again, diesel prices are continuing to go down. Currently, we are at, on average, $3.95 per gallon nationwide. Now let's take a look at this map, which shows us which markets had an increase and decrease. And we can see that for the most part, it's pretty red, which means that most markets are experiencing continuous decreases in diesel prices. However, there are some naughty markets, such as Miami, Florida, Lakeland, Florida, Montana, Georgia, Florida, and Texas, where there was an increase in diesel prices from last week. But in general, we can see that diesel prices are continuing to decrease, which is awesome. I do apologize. At this point, I actually got warm. You guys know, those of you who know me know that I'm cold all the time, but now I am not so cold, which is surprising. Okay, now let's take a look at the flatbed market, right? Where do you need to go? What to expect? So we are looking, again, as a reminder, these are charts by truck stop, and we're going to be looking only on the flatbed portion, at the flatbed portion. So what we're looking for is we're looking for places where the number of loads picking up, the outbound volume, is higher than the number of loads dropping off, the inbound trucks. That way, if there are more loads than trucks, of course, negotiation becomes easier. So in the western states for flatbeds, California, Oregon, and Washington. In the plain states, not a single state where there are more loads than trucks. In the Midwest, not a single state where there are more loads than trucks. In the southern states, Alabama, Florida, which was surprising, yep, Florida, Georgia, Louisiana, Mississippi, South Carolina, and Virginia. And then we have the Northeast, Maryland, and Maine. So what I can tell you right now is that the flatbed market has been struggling. Over the past week especially, and over the past 2 weeks, it has been a continuous decline in rates and volume as well. So unfortunately, yeah, having a little bit of a harder time with flatbeds the past couple of weeks, but it's not surprising. Usually we have at least a few states in the Midwest where you can find more loads than there are trucks. But this week, unfortunately, that is not the case. Okay, let's take a look at the flatbed map for my visual learners. The darker an area, the more negotiating power you'll have. So we can see that the south is the place to be. There are small parts in the Midwest, but you have to remember that they're surrounded by parts where there is overcapacity. So those drivers that are in a place where they cannot get a good load, for example, I don't know, somewhere here I think this is Illinois, they will deadhead to a place where there are more loads. And therefore, there will be more capacity in those seemingly tight capacity markets. Yeah, the Midwest, not a great place to be at all. Okay, let's go ahead and look at some van data, starting with volumes. As a reminder for those of you who are new, this is the volume map. The color shows us the change in volume from the prior week, not spot load volume, it's general freight volume. If it's blue, that means there was a volume increase. If it is red, then it's a volume decrease. So the height of an area shows us general volume. And again, we're looking at flatbeds. We can see that for the most part, in the Midwest, there were volume decreases, especially look at Michigan right here. In the South, there were volume decreases. In Texas, there was no change in Houston and the Fort Worth area, but there were some increases right here in the Laredo market, in the Midland, Texas area. But in general, we can see that it's pretty flat, so no volume, really. California experienced the volume decrease. Although Nevada, Idaho, we can see Washington, Montana, they experienced volume increases, but that doesn't matter because the volume, you see it's flat. That means that even though there was an increase from last week, there's no real volume there, unfortunately. So in general, yeah, I mean, pretty boring map in my opinion. Let's take a look at tender rejections for dry vans. Same concept. Red means that the tender rejections decreased from last week, which means that spot rates will most likely be lower. And blue means there was an increase. The height means total tender rejection trends, right? So we can see that the southern part of Texas, San Antonio, Laredo, not quite Houston, but Corpus Christi, there was an increase in tender rejections there. Also, New Mexico and portions of Colorado, which is surprising, Ohio, West Virginia, and parts of Indiana. And then there were slight increases right here as well. Everywhere else, there was no change or a decrease. Now let's take a look at the head haul index. Now, as a reminder, head haul shows us negotiating power. If the area is red, that means that it is overflowing with trucks. There are not enough loads to cover those trucks. There are more trucks than there are loads. If it is blue, that means that there are more loads than there are trucks in that area. Now, this is for the dry van. As always, pretty much the West Coast is not the place to be for a dry van, except for a small sliver of hope in California. We can see the Fort Worth, Dallas, Texas area is interesting, but it's surrounded by overcapacity. So whatever the ratio is here, load to truck ratio, it's going to be ruined by everyone who's deadheading here to get better rates. The Midwest is a hit or miss. Atlanta, Georgia, Louisville, Kentucky, we have portions of South Carolina. They are a little bit more promising in terms of negotiations, but for the most part, overcapacity with dry vans. So where do you have to go if you have a dry van? So this map shows us volumes versus rejections. What we want is a market which is dark blue or as dark blue as possible, because that means that the rejections are higher. The darker blue, the higher the rejections. And as high as possible, because that shows us volume. So we want to be in a market where there is a ton of volume and a ton of rejections. Those markets currently are the Fort Worth, Dallas area. That is probably the best market currently that I see, right? Another one is Southern California. It's coming alive. There's volume there. Rejections are starting to pick up, but also Wisconsin. Look at Wisconsin. Pretty dark blue. The volume might be smaller, but there are a ton of rejections here. And we have Louisville, Kentucky as well. The reason I'm not mentioning Huntington, West Virginia is because there's no volume. It's flat. Now, if I had a dry van, I would be probably running Texas to the Midwest and back. That way I'd be able to save on fuel, and it looks like the volume is there, rejections are there. There's something to choose from. Does that mean you're going to get an amazing rate per mile? No. It means that you're going to get a better rate per mile from Texas than somewhere from Utah, where it is white, which means there are no rejections there pretty much. So it's all relative. All right, same thing for reefers now. So we can see this is the volume map. Again, as a reminder, red means there was a decrease in volume from last week. Blue is an increase. Gray is no change, and the height is the general volume from that area over the past week. For the most part, for reefers, it's a dire, bad situation. There was mostly no change, and wherever there was a significant change, it was a bad change. There was less volume, except for Georgia and South Carolina, it looks like. Maybe Chattanooga, Tennessee, there's a little bit here, but the volume there in general is flat. As you can see, there's no height. So unfortunately, reefer volumes, yeah, they're going down. And the worst part is that California volumes are going down as well. So yeah, not great at all. Now, these are tender rejections. Again, works in the same way. If it's blue, that means that tender rejections for reefers in that market area, for example, right here, they increased from last week. If it's red, like right here, they decreased, and the height shows as general tender rejections. Oh my goodness. I mean, yeah, it looks like a bloodbath to me for reefers, unfortunately. Rejection rates are decreasing in California right now. So that is a bummer. People are going to California more and more because, to be honest, it's a pretty decent market to get out of with produce. It pays relatively well. We can see that there was an increase in the Seattle market. There was something in Minnesota, a good increase in Michigan. But yeah, I mean, in general, it is red, which means that reefer carriers are accepting more and more loads, therefore sending less to the spot market, which means that spot volumes are decreasing, and so are rates probably. So let's take a look at the head haul index. It's not as bad as for dry vans. We can see that there's still some hope in Central California, in Idaho. We have some portions of the Midwest. Fort Worth, again, is surrounded by overcapacity. But yeah, in general, there are some slivers of hope where you can negotiate better rates, but there is pretty much overcapacity everywhere, especially it looks like on the eastern and western sides of the United States, of course, with the exception of California, Idaho, and maybe Nogales, Arizona. But yeah, still not the best picture. Whoops. Let's take a look at where to go if you have a reefer. So if you have a reefer, we're looking for markets which are high, which means that there is volume, and which are as dark blue as humanly possible. The reason is because the darker blue, as a reminder, means that tender rejections are higher. So the only markets, reefer became so limited. I'll tell you something. I had to book a load from Indiana. I'll talk about it at the end of the video. Again, I had to book a load from Indiana today for a reefer, just a one load to get us to the flatbed rental place. It's a disaster. But the places where you can go with a reefer to get a more or less decent rate, California is definitely one of those markets. It looks like Idaho, even more so than the Pendleton, Oregon area. Michigan looks like it will come alive next week because of the tender rejections, and Fort Worth. Yeah, unfortunately, that's pretty much it. So if I was consistently booking reefer loads, honestly, I would do everything to run from like Fort Worth to California and back if possible. Although I have not seen many loads from Texas to California, because California is really, it's becoming a pretty decent market for reefers. But yeah, I can't say that it's such a great picture for reefers at the moment, unfortunately. We'll see what happens next week. So that's it for the market update and forecast. As we saw, tender rejections are on their way up, which is always a good sign. But if we look at the 5-year seasonality, we can see that we're pretty much at the bottom and not really moving much from the place we are right now. Now, as you guys know, I have been dispatching flatbeds over the past 2 months, a little bit over 2 months. I haven't worked with a reefer for over 2 months now. And today I had to book a reefer load. Complicated story. But we were in New Haven, Indiana, and I mean, it was a slap in the face, that market. To tell you that the rates are horrible would be an understatement. I saw rates, most of them actually. Now, granted, I started looking for a load only at around 1:30 p.m. Eastern, and it's a Friday, but the rates were like 90 cents per mile for a reefer, and these were not van reefer loads. And those were going to California. Now, the rates today shook me to my core, so I started searching. And of course, just like we saw on the market of where to go if you have a reefer, California is really, really decent. We have the Boise and Idaho area that's very, very decent. And then the Fort Worth and Houston areas, Texas, is okay, but everywhere else, it's a mess. But anyway, enough about the market. Let's talk about that AB5 law. For those of you who have been here for a while and watched my videos, you already know that we are a California-based carrier. Now, because of that, we are affected by the AB5 law. So whenever I would get emails, and I would get a lot of them from owner-operators looking to lease on, I would have to tell them that unfortunately we cannot do so because of the AB5 law, since we're based in California. Now that got me thinking a little bit over a month ago, and I decided to dig. My theory was that AB5 is really a state labor law. And if it's a state labor law, just like all state labor laws, it cannot apply to other states. It just doesn't work. So my theory was, if we lease on an owner-operator who is not based in California and never enters the state of California, then the law will not apply to us possibly. Now, I reached out to the Labor Commissioner's office, as some of you know, and I have been waiting for a response. The biggest question mark was, will AB5 apply to us regardless, just because we as a business are based in California? But a few days ago, I got a response, and my first theory was absolutely correct. So for those California carriers, yes, you can lease on owner-operators. Just make sure that you're actually leasing on independent contractors and not misclassifying. But you can lease on owner-operators and avoid the AB5 law applying to you, even if you are based in California, as long as you meet two requirements. Number one, the owner-operator cannot be based in California. That will automatically make the AB5 law apply. Number two, that owner-operator can never enter the state of California, because that is considered performing work in California. And the moment the owner-operator enters the state of California, the AB5 law theoretically applies to them. I don't know, maybe some of you already knew this, maybe I'm just really behind, but I wear suspenders with a belt, so I really needed written proof from California, from an official email, saying that this law does not apply in these cases. So of course, now we are looking at leasing on owner-operators. I just have to figure out the details of how it's going to be, what the compensation will look like, and all of that. But yeah, now we are working on that. Anyway, guys, I hope you found this video helpful. I hope you learned something new. Wishing the gentlemen in the audience a wonderful Father's Day, and I will see you all in the next video.